All right, welcome to lesson 1 in the technical analysis section. The first thing we're going to do is not waste a lot of time. I want to give you as much value as possible while respecting your time as much as possible, right? We have one goal, and that is to become a professional crypto trader. So in order to learn technical analysis and analyze your trades to find the proper setups and the right times to get in, the right times to get out, you're going to need a charting platform. That's why we're here on tradingview.com. It is my most recommended charting platform. They have a free tier and a paid tier, and we're going to go over the differences here real soon. But first, I'm going to walk you through the basics of TradingView. We're looking at a chart right now on a 4-hour time frame. And right here in the top left is what I want you to draw your attention to first. In the top left, we have the trading pair that we're looking at. A pair is just one currency paired against another. So here we're looking at Bitcoin USD. So this is the price per Bitcoin of US dollar, right? You can read a pair as 1 equals, right? Numerator equals denominator. So 1 Bitcoin equals whatever the price is, USD. And the price is currently $49,915 there. So 1 Bitcoin is equal to $49,915. Next, you have the time frames here. These are all time frames. We're currently on a 4-hour, as you can see. I have the 1 hour, the 2 hour, the 8 hour, the daily, the 3-day, the weekly, and the monthly time frame here. And of course, you can change your intervals right here. Put a star on the ones that you want to stay up here. Okay. We have indicators and strategies right here in this FX, but we're going to talk about that later in our indicator sections. I want to draw your attention now to the left little toolbox, little panel here. This is where you add your technical analysis drawing tools. Here you'll find your trend line, your arrows, your parallel channels, and all of that. Here you have your Fibonacci retracement and extension, which are very, very important. And here you have little rectangles and highlighters and triangles and stuff like that. Text box if you want to draw notes, price labels for price labels on your charts. And then for harmonics, we're going to talk about XABCD, ABCD patterns, Gartley's, and Boole patterns. All right. And then lastly, I want to draw your attention to the little tool panel on the right here, and the first one is your watch list. So this is where you keep your watch list of assets that you are paying attention to, different cryptos that you are looking for entries in or that you like to watch every day. These are mine right here, as you can see. This is my crypto watch list. I also have a Forex watch list here where I have my S&P and some equities up there, the volatility index, the dollar index, gold and oil, and then I have my USD pairs and my Japanese yen pairs and a few other cross pairs. Okay, but let me take you back to crypto. I like to divide it in different sectors. Go check out the sector section later in this course to learn about crypto sectors. But here we have currencies. Then we have smart contract platforms here in the blue. In the red, we have Polkadot ecosystem projects. In the purple, we have Cosmos ecosystem projects. These are 2 layer 0 protocols that I'm very, very interested in. And lastly, we have Ethereum ecosystem projects here in the green. All right, when you click on one, it changes the chart, and you're now looking at that chart, right? This is a little analysis I had drawn on ETH. I made a YouTube video about this called Top 5 Most Oversold Cryptos that were good to get into. We were up here when I made this video, and you can see it played out perfectly well with this head and shoulders pattern, which we'll talk about here shortly. And we are now very, very bullish, breaking that neckline. Let's go back to Bitcoin here. Lastly, in the middle, you have your chart, right? You can set up different alerts here. You have your headlines here if you want to read any news and, you know, a few other things that I don't use too much. They have chats and notifications and stuff like that. But the main thing we're going to focus on is our chart. So that's how you set it up. If you switch time frames here, each candle will change. We were looking at the 4-hour, which means every candle here represents a 4-hour time frame. Now, crypto is 24/7, so it never stops, right? So you're looking at this. Every candle will finish in 4 hours and the next one will open. You can see this timer right here on the side, 3 hours and 36 minutes. So in about 3 hours and 36 minutes, this candle will close and the next one will open 24/7 on repeat forever. All right. And on a daily candle, same thing. In 3 hours and 36 minutes, the daily candle closes. Daily candles close at 7 p.m. EST. That's Eastern time. And so depending on your time frame, it will be different for you. And then the next daily candle will open. I recommend to stick to 3-day, daily, and 4-hour charts for most of your analysis. You want to know the larger term picture, what's going on in the weekly time frame over the long term, right? You want to know if something is bullish or bearish, if it's going up, if it's in a bull trend or an uptrend over the long term. It's something you want to be invested in. So then you might go down to the daily or the 4-hour intraday time frames to look for entries. Okay. I want you to keep your charts for crypto on a log scale. You can see the log right here. You click on this and it turns the y-axis here into a logarithmic scale, which just measures in terms of percentage gains as opposed to number gains, right? Which is how the pros do it, and you'll see the difference there. It makes sense to do a logarithmic scale because we are interested in percentage moves, okay, as traders. And last but not least, you can see your indicators here. If you put the little eyeball here, you can mute them or hide them and then unhide them, and vice versa. And if you double click on your chart, you can have your hidden indicators. And I like to have my RSI here right below. We'll talk about RSI in the relative strength index indicator section. So talking about candlesticks, let's get started and learn about candlesticks in the next section. So the key takeaway here, guys, is to look for where you're finding support. If all this was happening on the 200 EMA, it would be the 200 EMA, right? But it's happening on the 100 EMA on this time frame on this chart, right? Now, sometimes, again, every EMA acts as support, and you only turn on the second one when the first one breaks. So the first one broke in all our circled instances here, except a couple here. You can see after this overbought, the dip buying opportunity was actually here on the 20 EMA. Likewise, after this, we never even touched it. So it was on, it never even happened, right? So we had another opportunity here in the 20. And after the next overbought, it never happened. And after the next overbought, we came down to touch the 100. Okay. So the 20, and while it didn't happen on the next one on price chart, you can see it happened on the RSI support level, and just like always, just like price chart, previous resistance becomes support, right? You can see we have two bounces off here. Now it's holding a support. After this overbought high, we consolidated sideways. We did tap the 20 EMA, and what did we do there? You can see that hammer candle. We printed a hammer candle on there that respected the 20 as support, and we established this previous resistance level as a support level, right? And then the next one that we spoke about right here, when we got into overbought territory, we did not come down to touch our EMAs on price chart, but we did get back to this RSI level, indicating that price might hold, right? So this one was a harder one to trade, but we did have a bit of a bullish engulfing candle there. Then we made higher highs, and so there were a couple of clues, but it was harder to trade. But that being said, there were several opportunities on this chart, right? If you count the ellipses after overbought on the support, 1, 2, 3, 4, 5, 6, right? 7 with the one that happened on price only at the support level. And this was all in the past 2 months. You can see this was January 11th and it's about March 7th. So 2 months or so, 6 or 7 buying opportunities. This asset, Cardano, it started around 20 cents here and has a high of 150. So that is a 7x on your money with a system like this. Being aware of what price holds and using RSI overbought pullbacks as a bullish indicator, right? So key takeaways from this. We're in a bull trend. Overbought might be the end of a current move, right? It might indicate that we're making a high here, but again, we're in a bull trend. We're making higher highs and higher lows. We expect to be making highs at some point, so don't get scared. You could take profits there. That would be smart too. And if you don't, and then buy back if we happen to touch the 100 and the 40 RSI. Key takeaways: it's a bullish signal on a pullback is a great value point to accumulate your bag or to re-enter if you have sold for profits. And as long as we're doing this, we're making higher highs and higher lows, right? And the opposite would be so for a bearish trend, guys. And I would like to see the RSI stay below 60 and above 60 and below for bearish trends in a likewise manner. And last thing we're going to talk about here, guys, let me just clear all these drawings, is divergence, okay? This is called bearish divergence. When price makes a higher high, you can see we went from here to here, so the slope is upwards because it's a higher high, but at the same time, RSI made a lower high. Always compare highs to high, because I've seen people, they'll be looking at the higher high on price, and then they'll be comparing to the lows on the RSI. But no, if you're comparing highs, compare highs. If you're comparing lows, compare lows. So higher high, but lower high, this is called bearish divergence. It's a bearish signal. And again, it's a bull market. So just because you see bearish signals does not mean the whole trend is becoming bearish. It just means it's the high. It might be the local high where we go on to make a higher low now. Yes, we'll pull back a bit. Yes, we'll make a higher low. But, you know, there's nothing wrong with that. You could take profits when you see these bearish signals, or you could accumulate on the pullbacks. And again, the RSI pullbacks we just spoke about, the EMA pullbacks we just spoke about, and in the next chapters we're going to talk about harmonics and Fibonacci's, which is how you will master pullback entries and profit taking targets, especially when you combine it with price action, EMAs, and an oscillator like RSI. And real quick, guys, we talked about bullish divergence, so let me just show you bearish divergence. It would be a scenario like this. It's hard to find in a bull market where price made a lower low, so the slope is downwards, and since we're looking at lows, we're going to look at lows on the RSI, and price made a higher low on chart. And this is not the best example because, sorry about that, because this is kind of a sideways slope, right? But it didn't make a lower low, right? You want to see a lower low. You want to see it the exactest price for everything to be normal. Now, since you have a sideways move, or if it was even a bit upwards, pretend it was a bit upwards, that would be bearish divergence, right? Because you're making a lower low, but with less momentum, okay? Likewise, the bullish divergence, the bearish divergence here, sorry, this would be bullish. That would be bullish divergence, right? Because you're making a lower low, but without as much selling momentum. So it's a sign that bulls are coming in. Same thing, even though this was sideways, you made a lower low, but RSI didn't come lower, which it should if you're making lower lows. So this was a form of bullish divergence. And likewise, for bearish divergence here, what it signifies psychologically is that you made higher highs, so buyers were able to push price higher, but there weren't that many, and it wasn't a lot of buying volume or buying momentum because they came up with less strength, with less momentum, as you can see on the RSI, than they did on this peak, and that was the bearish divergence.